Imagine this for a second. It's the middle of a financial storm. Stocks are tanking, people are panic selling. But then there's this one company, maybe it's Johnson & Johnson or McDonald's, that not only keeps paying its dividend, it actually increases it. That's not a fluke, that's a philosophy. And there's a whole group of companies that follow this blueprint. Businesses that have raised their dividends every single year for 25 years or more. We call them Dividend Aristocrats. And the ETF that gives you exposure to this elite club, it's called the ProShares S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL. In this video, we're going deep. I'll walk you through what NOBL is, what makes it special, how it performs, and whether it's worth a spot in your portfolio, especially if you're building for long-term income and stability. But before we get to the video, if you're new here and you've never seen my channel before, my name is Elliot and I upload videos about investing, the stock market, and I do updates on my own portfolio, which is on the Robinhood app. So if that's something you enjoy, please consider subscribing. I upload videos just like this every 2 weeks. NOBL tracks the S&P 500 Dividend Aristocrats Index, which is composed of companies in the S&P 500 that have raised their dividend payouts for at least 25 consecutive years. That might not sound dramatic at first, but think about it. That's 25 years of dividend increases. That means these companies have raised dividends through the dot-com bubble, the 2008 financial crisis, COVID, interest rate hikes, inflationary shocks. To do that, a company needs to be incredibly resilient, financially disciplined, and committed to shareholder returns. One of the first things you'll notice about NOBL is that it's not your typical tech-heavy index fund. In fact, you won't find giants like Apple, Amazon, or Alphabet here, because none of them have that dividend track record. Instead, NOBL is made up around 68 companies from the S&P 500 that meet that strict 25-year rule. And importantly, it's equally weighted. That means each company carries roughly the same weight in the portfolio. PepsiCo doesn't get to dominate just because it has a bigger market cap. It stands shoulder to shoulder with, let's say, McDonald's. Here's a few names you'll find in the fund today. PepsiCo, Coca-Cola, McDonald's, 3M, Procter & Gamble, Johnson & Johnson, Lowe's. These are household names, companies that have been around for generations, and they're just not surviving, they're rewarding shareholders year after year. The term dividend aristocrat was coined to recognize companies that show not just profitability, but reliability. Back in the early 90s, dividends weren't all that popular. People were chasing growth stories, but some investors saw the value in consistency. That's when the dividend aristocrats list started to gain attention. Over time, funds like NOBL emerged to offer easy access to this group, so you didn't have to go handpick 50 plus dividend stocks on your own. Let's talk returns. Over the last 10 years, this ETF is up over 99%. NOBL has delivered steady, reliable performance, though it's not a rocket ship. Here's the key. NOBL tends to underperform during bull markets because it's not chasing tech or growth, but it outperforms during corrections and bear markets. In 2022, for example, the S&P 500 dropped over 18%. NOBL, it was down just about 7%. That's a huge difference when you zoom out over the long-term horizon. It's like having a shock absorber in your portfolio. You might not win the race in the first lap, but you're also not going to crash in the turns. Currently, NOBL's dividend yield floats around 2.14%, which is higher than the S&P 500, but the real magic isn't just the yield, it's the growth of that yield. Because these companies raise their dividends annually, the income you get today is just a starting point. If you're reinvesting in those dividends, you're compounding not just capital, but cash flow. For people planning early retirement or just wanting to grow passive income, this is where NOBL starts to shine. I'll be real with you. I used to chase shiny objects. I wanted the next big growth stock, but I've come to appreciate the quiet power of consistency. I mean, let's face it, a company that increases its dividend for 25 or more years is doing a lot of things right. Investors love NOBL because it gives you access to high-quality proven companies, offers growing income, tends to be less volatile, and aligns with a sleep well at night strategy. It's not going to triple in a year, but that's kind of the point. Now, no ETF is perfect, and NOBL isn't either. First, the sector exposure is skewed. Consumer staples, industrials, and healthcare dominate the fund. You won't find much exposure to sectors like technology, energy, or emerging markets. Second, the expense ratio is 0.35%. It's not crazy high, but more than a fund like VOO. You're paying for that equally weighted rebalance and the 25-year dividend stream. Third, NOBL is relatively concentrated. 68 stocks may sound like a lot, but compared to VTI or VOO with hundreds or thousands of holdings, it's actually pretty narrow. So you probably don't want to build your entire portfolio around NOBL, but as a component, a long-term foundation for income and stability, it can play that role beautifully. If you're someone who wants exposure to high-quality companies, values growing dividend income, and isn't obsessed with short-term outperformance, then NOBL is worth considering. Retirees love it, long-term investors love it, even younger investors who want to sleep better at night love it. You know, investing doesn't have to be exciting to be effective. In fact, some of the best strategies are, well, kind of boring. And that's what I love about NOBL. It's boring in the best possible way. It's made up of companies that just do what they say they'll do, and then quietly hand you over a dividend check year after year. They're not trying to disrupt the world. They're trying to run great businesses and reward patient shareholders. And over time, that can make you very wealthy. If you enjoyed this video, please make sure to give it a like, subscribe to the channel, and let me know in the comments below. What's your thoughts on this ETF? And we'll see you next time.